Oh yeah, and we are back. Another day, another dollar. Monday, May 16th to 3:33, and you know what that means. Time for another episode of Jones and Friends. And Chris, I don't know if I've ever been as excited as I am for this episode.
You're usually excited every Monday. You're so relieved to be done with those 2 days that we call a weekend. That's a
That's true.
reprieve of whatever
I'm
we
a
do at home
I'm a
when the
total
show's not home.
degenerate for 2 days. I Uber Eats it. I don't see the light of day, and then all of a sudden, I get to speak with adults again instead of 2-year-olds and 2-month-old, and I'm excited and ecstatic, ladies and gentlemen. Um, we have a very special guest. We sort of teased it out, and we teased it out last week, but without further ado, let's go ahead and welcome to the show to Jones and Friends, Jem Karsan. Jem is the CIO, founder, and managing principal at Kai Volatility Advisors. Jem, how you doing, man?
Good. Thanks for having me.
Thanks for being here. Wild OPEX week. We titled this something very specific, which is stocks lower, vol lower, what gives? And ironically, maybe a week or 2 weeks ago, you were talking about the fact that we could very well see this. Before we get to all of that, man, can you tell the people a little bit about your background?
Sure. I started in the business in 1998 as long-term capital was kind of fizzling, and really started trading 99, 2000, top of the tech bubble. Became one of the biggest traders for RBC Dominion, the market making firm. Eventually split off, started my own market making firm, and that became the biggest in volume in the equity indexes during the great financial crisis. So Precision Capital, my firm, 2006 to 2010 was more than 13% of the volume of the S&P 500 among other indexes. So that's my background. Sold that business in 2010 and then started Kai Volatility Advisors. It was originally kind of my family office, and now manages external assets with 3 different hedge funds, non-correlated funds that for qualified participants.
Look, you need very little introduction, but that's just for the person that's been living under a rock. Everybody that follows us, their WSB Degen or their FinTwit community, they've already followed you on Twitter for sure. And, so they've been catching all the alpha you've been laying down for maybe the last 2 years about what this potential future that we are headed into, what it could look like. We'll get to the macro discussion in a while, why you felt like, we could be heading into the exact scenario that we're in right now. Before we get there, I actually want to start short term, if that's cool with you, Jem.
Absolutely.
Let's start short term and let's work our way into this OPEX and then back our way out into a longer term macro view. And I just wonder, before we get to dealer positioning, if you could talk about the importance of option flows as you see them. When I started, options made up like 9%, less than 10% of individual retail flow. They now make up 1 out of every 3. And I'm just curious from your point of view, how important is it? And if there's a way for you to quantify exactly how large it's become.
The word derivative in my mind is a bastardization of what options and derivatives are. Derivatives are not an asset class. They're not a different product. They are the underlying distribution that underlies every single asset. When most people think about investing, they think about going long or going short, buying or selling. When we think about different assets, we think about the distribution of probability of different outcomes for 2 assets. I could give you 2 stocks from the same industry with the same market cap, and based on stock price, you'd think they were the same. But if you look at under the hood, at the distribution of risks and return for that asset based on the option chain, you would realize that they're completely different assets with different risk and return. And so most people have been living and looking at the world from 30,000 feet and don't really see what's going on a micro level. But options are a very rich source of information and a much more flexible, dynamic way to bet on outcomes for assets. So options are a superior, I think of it as a superior technology, a superior product, much like other things that eventually get adopted and hit a tipping point, and eventually get those network effects, right, to grow into kind of a dominant form. Options have secularly increased because they do provide, like I said, more flexibility, to bet on different outcomes and different information more precisely. Network effects work in funny ways. You get increased access over time, increased education, increased broad liquidity, or different people involved, right? More in a technology. So that's what's happened. It's not like Robinhood came out of nowhere. There was a demand for it, and it filled that void. Tasty Trade didn't come out of anywhere, right? The education that you guys provide and that other people do has helped accelerate what's a secular trend. Now, fiscal policy and what happens and affects these things in different ways. Obviously, the inflow of money into individual bank accounts, allowed retail to bet on more convex trades, which is what options are good for, nonlinear outcomes, and that has accelerated obviously the process as well. But this growth it has been secular, and I really do think we've hit a tipping point that's been accelerated by COVID and the fiscal response that we got. Long answer to a very simple question, but that's kind of how I see the world and how I see options.
Listen, you're a guest on our house. Long answers are good. The people want to hear from you. They hear from us every single day, Jem. I wonder then, let's go another step down the rabbit hole then, which is the importance of dealer positioning. So you talked about the importance of options, but talk to the importance of dealer positioning, because from the retail point of view, that's not always something you come into the business and you're learning about. You're just, what is a call? What is fundamental analysis? What is macro? Maybe I'm holding on to that stuff, but the dealer positioning is something on the institutional side. It's of great importance, and retail investors starting to become more informed on this aspect.
Yeah. So the concept of reflexivity has been talked about ad nauseum over the decades. Soros is well known for his view and his successes by thinking about reflexivity and its effect on markets. But the actual quantitative, reflexivity that we see in markets can be actually measured in many ways. If you look, at supply and demand, people have used short interest for stock, for looking at the reflexivity and the potential squeezes, and effects that come out of that for quite some time. But on the option level, you can really measure what the bets are in time and moneyness very precisely if you know what you're doing, and judge because of that the reflexive effects of that positioning on supply and demand. And so, we for some time have seen the benefits of understanding where the dealers are positioned and how they're hedged and how they will have to react as time changes and as vol changes and different dynamics change in the marketplace or market moves. So we've been measuring that for some time and reacting. A lot of other people are kind of new to that space, but that creates a predictive edge. It creates an understanding of where there's risk in the market, of where there's demand, where there's supply, and what that can mean ultimately for the distribution of outcomes.
Jim, why don't you tell us a little bit about the current state of volatility in the market right now? What's going on with the VIX? I know some people think of it as its own asset class or a gauge of fear. What's your take on that whole conversation? What's going on with skew? What's going on with the term structure of volatility? Help bring some knowledge, some perspective for our Tasty Trade crowd. And if you're listening in, be sure to like and subscribe if you're following us on YouTube.
So that's a lot of questions. I'll start with the big one. Is VIX the fear index? The answer is no. The VIX measures at the money, some calculation essentially, without getting too detailed, calculation at the money vol. But at the money, it does that via looking at options in the S&P 500. Now, the S&P 500, vol is not the same at every strike. If you look down, there's a thing called skew. If you look down lower in the market, there's a higher implied volatility to those options. And that fixed strike vol, if the market goes down, should slide right to that vol. There are plenty of times when we go down and we actually slide, and this is what's been happening in the last year and a half, really, particularly last 3 to 6 months. But we've been sliding when we go down to higher vols, and that vol has been coming down. But the VIX is going up. So, a lot of times you see the VIX go up and the market down, and people are like, oh, people are afraid. But the reality is quite the opposite might be true. Fixed strike vol might be coming down, and often has been. And if anything, it's a sign that there is no fear and that people are hedged, and that the market is going down for other reasons other than fear, despite the fear, right? Despite the hedging, right? So the answer is the VIX is not the fear index. It is not understood. If there is a fear index, it is fixed strike vol. And the understanding of the relative performance of option implied volatility relative to where they're actually priced, which the VIX does not measure. I know everybody wants it to be easy, right? It's not easy, but that's why there's value in understanding these things, because not everybody has that perspective. All right, so that was the first question. After that, you asked me, what's the current state, I believe, of skew and markets and how have things been moving? I kind of addressed it a little bit. But let's rewind the clock a little bit to February of this year, when the continuation of the decline from January was happening. Positioning at the top, really in December, January, was very well hedged. Skew was quite high because there were a lot of buyers of puts at the top. There was a broad expectation. We were very much out in front of that. A lot of other people were as well, about the problems that would come from the Fed tightening and a lot of the other issues that we've seen coming, driven by fiscal policy relative to monetary. So people were well hedged. A lot of people expected this. The decline that happened at first, we expected to be slow after that rally, the Santa Claus rally in January effect. But once the market came down in February, skew had really flattened, vol had really underperformed, and the signs were very much there for a snapback rally. And we really thought that we would get a final, and what has happened historically before the end of these big cycles is some type of snapback, blow off top. And I think we were very much set up for that in early March. I still believe that we would have gotten it. But then a little thing happened in Russia and Ukraine. And so people were hedged. Vol was very oversupplied. As I like to talk about Gary and the reflexivity, like people, implied volatility was very well supplied when Russia invaded Ukraine. And so instead of getting that bounce back rally, this Russian invasion of Ukraine is huge, because as we all know, it's created, knock-on effects to inflation primarily, right? Which is forcing the Fed's hand even more. The Fed is ultimately what matters. Liquidity is what ultimately matters, but that Russian invasion of Ukraine really exacerbated something that was already a problem and accelerated the downturn, the macro downturn that we are seeing. So it forced a market down, vol down regime, because people have been hedged. Reflexively, if the world is long stocks been hedged with convexity, the worst thing that can happen to people is market down. All your options get killed as well. And so that's been the pain trade. It's caused kind of the really slow motion train wreck we've been seeing. And again, it's a kind of an irregular end to a market cycle, but we do believe it is the end to a market cycle. We believe those highs are all-time highs and will stand for some time now. That's our view. Now the markets are hedged, so until we get something, another knock-on effect, right? Something else that's unexpected, we are probably going to see more of the same, right? Again, people are reflexively prepared for this, but the Fed is definitely hell-bent on removing liquidity and slowing down the economy till we are in recession and till inflation sees the white, we see the whites of the eyes of inflation. So this is, but the reflexivity is an important part, is understanding that skew and that vol is not going to perform no matter how cheap you think it is in the short term, because the world is hedged and the world is long that. Now, that is where we have been and where we're likely to be in the short term, short to midterm. However, there are plenty of historic examples of these cycles eventually end, right? Eventually people are going to start liquidating these puts. We've started to see a little bit of it actually, and start giving up on vol and skew. The best trade that you could have done in the last, call it 3 to 6 months, is sell puts and sell stock. And that's an easy trade, because, selling puts is, the easiest way to make money in the short term, right? But it has a tail. So eventually creates a moral hazard, gets too crowded, and then the opposite thing happens. I've alluded to this, talked about this broadly, about the second move phenomenon. We can point to this in a couple of different places. August of 2015, we got the yuan devaluation, massive vol move. implied vol move relative to the size of the market move. If you were short vol, a lot of people got blown out. It was the first time we got a real vol move, really since 2011, and caused a situation where everybody who was short was blown out. Everybody was long, made a bunch of money, and implied vol was still cheap after the rally back. So everybody started buying skew after that, right? Oh, I'm not going to be short that. I'm not going to make that mistake again, right? And so enter February 16. This is when high yield started blowing out, particularly in the oil patch. That was the first move down to the 20s, I believe, for oil at the time. You got the first real 12, 13% decline. It was actually a bigger decline than August of 15. But it was a historically low, it was actually a liquidation of implied vol, because as people were blowing out on the high yield side of things, they were also having to liquidate their puts on the downside. So you actually had the tornado come through town, and everybody was selling tornado insurance and liquidating their insurance. It's a very odd phenomenon. It's the first time we'd really seen that in some time. But that was a direct response to August 15. That was a second move. What happens when that happens? All the people who are long vol, nobody's buying vol after that, right? If it's not going to help me on the downside, there's a carry to vol. Why the hell would I ever own it? Which led to 16 and 17 and the lowest implied volatilities in history. 2017 was the lowest implied volatility by 30% of any realized volatility of any other time in history. Also the lowest implied volatility. That reflexively pinned markets, et cetera. I know I'm giving you a market history, but I think it's important to understand how these things work. Which eventually led to overcrowding, and after quite some time, exactly a vol apocalypse, and we got a real vol event in February of 2018. What happens after the vol apocalypse? Well, nobody's giving those guys money anymore. Anybody who sold that vol, it's just a big pendulum, right? And it takes a while, but that made 18 all the way through to late 18, good time to sell vol. And guess what? Even late 18, now people were hedged, right? People were buying puts, and that decline in the 2018 a decline, which was October, November, December, which was slower, and vol and skew got absolutely decimated into a decline again. Very similar skew multiples that we're seeing now. So it's all about social psychology, right? March, the bigger the decline and the more pain people feel, the more it's likely to be a good time to sell vol, and the more complacent people get, and the longer it's been since something's happened, better time it is to buy vol. So it's been an incredible time to be short vol throughout, since March 2020, right? Because again, we had that first move, and now we're in an extended, second move phenomenon. And our view is that we are beginning to see complacency creep in. There's still some time. It's going to, a lot more people who are buying puts and going to get burned on those puts for a bit longer here. When everybody starts to really give up and say, God damn it, why would I ever own puts? This is such a waste of money. I'm redeeming from those long vol funds. I'm never buying a put again. And I think we're in the eighth inning there. I think something ugly this way comes. So that's my view. I think there's a bit longer of this to go here. People, meaning maybe 3, maybe even 6 months. But there's something sitting out there on the tail, which will be colliding and connecting with ultimately what which is a much bigger macro decline in my view.
Before, and we're really excited to get to that macro discussion. In the short term, though, I wonder if you could you got a bunch of vol sellers out here that are typically on 45-day cycles or 45, 21-day cycles. I wonder, you've got a bunch of people squawking out there about the potential for people to monetize hedges, a bit of a short covering rally. You got the S&P down to 3850, a forward multiple in the S&P somewhere around 16, 17. All of these things, and you're thinking what's the risk reward of, leaning short deltas here? Maybe there aren't. You saw a bunch of short covering last week. I just wonder if you look at positioning here and, into the short term, your quick summary on how you're thinking about this expiration, how you position on the opposite side of this expiration really quickly as a summary to the discussion you just mentioned.
Yeah. So in the very, very short term, mid last week, we were very vocal about how skew was back at that Feb 16 type low. It really flattened to kind of those historic levels that we only see at short-term bottoms. Based on where we were in the cycle too, in the expiration cycle, given the VOMA and VEDA flows and the VANA and CHARMA flows, the world and dealers in particular were decaying longer vol, shorter delta. Perfect window to play for a rally. That 38.5 area is an area we had targeted for some time. That was actually almost the exact VWAP of the March 2020 low. That was a great place to get long. The timing worked great. And going into Wednesday, which is expiration, broadly that vol compression will continue. And that delta buyback, which comes primarily from VANA, and CHARM, you should continue to see. But the key is watching what's happening in the context of that, right? In the context of everything that I've just mentioned, this rally has been very weak. I mean, this is we should be getting back to the 20-day. We should really be kind of building momentum, and that's important. It's important for those things to happen because momentum is an incredibly important factor in lots of ways. It drives quantitative strategies like vol targeting and trend following and risk parity, and I can go on and on, right? And there's so much momentum driven factors, and if this market can't get going, in this window, which is so critical, given that low and catching and how short, how much short interest there is and how much poor sentiment there is, that tells you a lot. And so, and there's basically that a lot is the Fed, right? It's essentially liquidity coming off the table, demand for stocks coming off the table, broad stress on portfolios, and overhead supply. There are, those are hard things to measure, but in the context of everything else, you can really get a sense of how strong those flows are. So, after expiration happens, that tends to be a general low for the cycle and vol. Not always, right? But that tends to be, there's a tendency for the easy trade in vol to be done for that part of the cycle. And, and sometimes it takes till Thursday, Friday, but this is the beginning of the window if you're being conservative Wednesday morning. And so it's a time to be more cautious, right? It's a window of weakness, which I've deferred. It's not really a window of weakness. It's a window of non-strength. It's a window of where VANA and CHARM flows are being pulled off the table. The market will show its true colors without those technical flows. We've been playing for the rally, watchful to see if we can get it moving and to continue to push higher. And kind of the relative weakness the last couple of days, in particular today, was, I think, fairly telling. So,
but if it doesn't come, look out below. And this is what I've been telling Chris this whole time. I got soup cans in the storm shelter. Look, I'm ready, Jem. Okay, he's been laughing at me. I got gold bars in the safe. I'm ready for whatever this market wants to throw at me, and whatever lower liquidity is going to throw at me, Jem. Yep. But Chris has been laughing at me the whole way. We'll see who laughs last. We'll see.
Yeah, it's going to be a train wreck, but it's going to be a very slow moving train wreck at first, as we've seen. But these things eventually, there's just not enough liquidity on the tail eventually, right? And so no matter how well people are hedged, at some point, it will get bad. But it may be 6 months, it may be 9 months, it may be a lot longer than people expect. Probably will.
Yeah, you keep talking about this term liquidity. One thing that Victor and I have talked about today before the show was this great analogy. You call it hokey. We think it's spot on about airplanes and 30,000-foot view, and how fundamentals may or may not matter at certain cycles in the market, right? When liquidity is plentiful and QE is being pumped into the market, who cares? Everything's just going to go up. Line goes up. But now we're seeing this liquidity pulled out of the market. Can you explain to the audience how you view, when and why fundamentals matter, why the liquidity in the market and the Fed matters so much for this current phase of the cycle?
Yeah, I mean, you've probably heard the the kind of the weighing machine and the voting machine, right? Over the long term, people, the fundamentals matter, but over the short term, all that matters is how many buyers and sellers there are. And why do fundamentals matter over the long term? They don't matter over the long term because ultimately valuations matter in all market cycles. They matter because eventually there's not infinite liquidity forever. And ultimately, the way a stock survives long cycles, or a company survives long cycles, is at some point they will need to provide their own liquidity to survive. There are business cycles, and there's not always liquidity available. So, fundamentals matter because in periods when there's less liquidity and cash flows are actually worth. They allow stocks to buy other companies and to fund their own businesses and to buy back their own stocks and ultimately create their own demand for their equity. But during periods of infinite liquidity, like we've seen essentially for the last 20 years plus, all that matters is, are there more buyers or are there more sellers? It does, because there's infinite liquidity. Companies like Tesla would not have existed in a period of no liquidity, because they wouldn't have been able to have the cash flows to create the 20-year moonshot that they did. I'd argue Amazon as well, and even which is a lot of people will argue with, great company, now it has the cash flows, but doing the kind of 20-40-year moonshot that they would have needed, the cash flows that they needed to do that would never have existed under another regime. So that we've been in a monetary stimulus driven economy for 40 years. And that's created a technological revolution. People think that this is a normal, any kid that's been born in the last 40 years or last 50 years, thinks this is normal. For the most part, in the 1940s, 1930s, 1950s, 1960s, even 70s, people would always write science fiction books and talk about the year 1984 or the year 2000, or they do the Jetsons and talk about the year 1980 and expect the future to be here, and it never came. But in the last 40 years, the future has come way quicker, particularly in the last 20 years, than anybody ever could have imagined. And that's really a direct effect of monetary policy and liquidity. Unlimited dollars, unlimited money, and a need not to make money today, but to dream and to bet on big outcomes of the future is really something that's been driven by the Fed and monetary policy. So I kind of gave a long, winding answer to a very short question, but our view is that fundamentals don't matter in a period of infinite liquidity. All that matters is supply and demand ultimately, and that's what you see. That's why you get bubbles during periods like this. And ultimately, that's why growth has dramatically outperformed. The value of money has been zero. And if the value of money is zero, all that matters is dreams and aspirations and long-term outcomes. The discount rate is ultimately zero. Think about it however you want to think about it. But that duration trade comes off the table when liquidity goes to zero, because cash matters, because it's the only way you can survive. So that's the feedback mechanism, and that's when valuations matter. Discounted cash flows, not a term that most kids in their 20s and 30s understand and think are relevant. They're going to get a rude awakening when liquidity comes completely off the table. There are a lot of value investors who've been been trying to figure it out for 30 years. It hasn't mattered, right? I don't care. Discounted cash flows haven't mattered, but guess what? There's a reason that Berkshire's doing really well right now. A lot of those names are going to matter again, and over the long run, that's in these cycles is when it matters.
You mentioned Volpocalypse earlier. I remember reading Chris Cole's The Alchemy of Risk in like late 2017. And I remember the line, you cannot destroy risk, you can only transmute it. I wonder if you could speak to, this sort of this infinite money printing that has been going on. I wonder if you can speak to how you think that's transmuted equity market volatility. I mean, obviously we've been doing this in many ways to sort of avoid asset market volatility. In some ways you can look at it and say, maybe that's led to wealth inequality. In some way, maybe that's lending itself towards political volatility. I just wonder if you think this money printing is having sort of unintended consequences outside of asset class volatility.
Oh my God, like softball, Victor. This,
baby.
It is the cause of almost all kind of the structural issues we have in this world right now. It's that big. I cannot emphasize that enough. Monetary policy is free market economics on steroids. It is nature. It is survival of the fittest. It is giving the best violin players the best violins. Yes, you create infinite music, infinitely beautiful music. And if there were not human beings in the system, there were not like violin players that had the worst violin, did not play the violin very well. It wouldn't matter. This would be the optimal outcome, and we would maximize GDP by doing infinite monetary policy. You would, have price stability and maximum employment forever. But there are human beings in the system, and it's a tale as old as time. I mean, absolute power corrupts absolutely. The fittest get all the resources, but at some point we're human beings, and we're social creatures. We live and work in communities, and at the end of the day, there's this idea of justice and fairness. Those aren't natural structural things; they are things that societies create. And at the end of the day, this is not "quote unquote" fair. Now, whether you're right or left or what you believe in, that's the reality. And populism has been completely directly tied to this. We have seen, to put it in numbers, 1.75% approximately real GDP growth over 40 years, of which 0.75 of that has gone to the median, and about 1% has gone to the top 1%. That's for 40 years. 1% for the top 1% is like 100% growth per year for 40 years. It has not arguably caused inequality. It has caused dramatic inequality. We have hollowed out our middle class in America. And again, I'm not saying that's a good or bad thing. This is not a political statement. I want to be very clear. This is how the machine works. And at this point, that populism it created Donald Trump and it created Bernie Sanders. It took everybody left, right? Rusted out cities and, in the Midwest, that whole thing, that's populism. Everybody thinks Trump is right. He's left, economically left. So then Bernie Sanders obviously even more left. So populism is, they're just a mirror on society, and society for the most part is fed up. That's one way to kind of think about it. I said everything. Think about crypto. Why does crypto exist? Why is that here? Very simple. You have two generations over 40 years who have grown up as the bottom of as labor, and have never been able to catch up. They haven't been able to have a down payment for homes. Home ownership is at record lows. They haven't been able to build a nest egg. They have a dramatic distrust of government because of inequality and how rich the rich have gotten, how poor the poor have been left behind, particularly millennials, because the baby boomers were the ones with the assets, and they're the ones who made all the money. That's why there's this class, not just class, but generational warfare, boomers versus, millennials on down, Gen Z, et cetera. And so, the generational divides that we're seeing, crypto was not just, okay, we have a distrust of government, but as we talked about, this technological revolution that we live in came via monetary policy, so that those generations believe technology can solve everything. So distrust of government, the technology as the solution to all problems, and they got to catch up. They need convex trades. So guess what? YOLOing calls and crypto and convex growth trades. This is what monetary policy and what the Fed has done has driven our societal outcomes and where we are now. So not understanding that and not looking at what that means now going forward is you do at your detriment. Don't fight the Fed has been a mantra forever, but people take that in a very myopic way. You have to understand who the Fed is, what they're doing, what that means for society, and what that means for political outcomes and likely outcomes for markets on a generational level as well.
What does that mean for, I wonder, let's think, the Fed is basically telling the markets that we're going to turn off this monetary stimulus like faucet, right? There's a pipe, I've heard you describe it as, or this money gun, whatever you want to call it, or whatever analogy metaphor you want to use. Does that really mean that help is not on the way, or does that mean the stimulus just comes from the other side? In other words, how does monetary policy stimulus, how does that potentially shift to fiscal policy impulse as we go forward? And is that a good thing, a bad thing? Like, what's the impact for markets as you look ahead, knowing what the Fed is telling you? Do you believe them? Do you think they're going to pull it off? And then what do you think that means for fiscal policy impulse? We've already seen some things come out of California and the like. What do you think this means going forward?
Yeah, so we passed about 11 or 12 trillion dollars in fiscal stimulus in the last 2 years, year and a half. That is in real terms 10 times the size of the New Deal. The New Deal. I mean, the thing that plugged up the great hole called the Great Depression, decade-long hole called the Great Depression. Yeah, that one. Relative to the size of the economy, it's about the same size. And a lot of people will be like, oh, it's not 10 times, economy's a lot bigger. True, about the same size as the New Deal. It is a order of magnitude bigger than the Obama stimulus, which was the response 2008 financial crisis. So this is obviously going straight to demand, and it was inflationary at its core. The second it came out, we've only spent about 2.5 trillion to 3 trillion of that 11 to 12. So there's a lot more on the way, whether they pass more or not. So yes, more fiscal is probably coming. We can get to that, but there's already a ton in the pipe. And it's coming. Like it's flowing, and it's not going to stop for some time. So and fiscal stimulus is very different than monetary stimulus. Monetary stimulus, as we talked about, is supply side economics. It's money to capital. It is money to stocks. It is money going, as I've referred to before, to Planet Palo Alto. Money that goes to Planet Palo Alto does not hit our shores. It is a superior planet where they make amazing technologies, but we trade with them, and they send their technologies back to our world. And those technologies are deflationary, right? You send new advanced technologies, and that's supply. That's more supply. So monetary policy is supply side economics. It's actually deflationary because you're adding money to supply, not to demand. And that's what's really counterintuitive. People don't understand. People think fiscal and monetary are similar or somehow related. They're actually opposite in a lot of ways. I mean, it's not this simple, right? There's a wealth effect because of capital. People invest, in capital, et cetera. And then there's labor and there's trickle down economics that comes to supply. But without getting into too much in the weeds, right? Like the demand side economics is very different. It causes goods prices to go up. It causes revenue to increase for companies. But at the same time, the money that's going to investment to these corporations comes completely off the table because you have inflation, and the monetary policy has to come off the table. Otherwise, you get price instability. So the answer is we will continue to get fiscal policy, in my opinion. The zeitgeist has gone from inequality to now inequality plus inflation. And so if you think about, okay, we thought we'd get responses to inequality, which would be fiscal policy, and we got it. Now you still have inequality. People like those they're doing better. Their balance sheets are better. They feel good, but they don't like this inflation. So now what do you think government response is going to be? Well, we better do something they're not going to call them price controls, but something where we can fix this inflation for these people as well. And whether that's first time home buyer credits or tax holidays for gas, or you call it, they all sound a lot better when you put it that way instead of calling price controls, right? But that's the stuff we're likely to see. We're already seeing a lot of stuff coming out of this administration, and again, it's left or right. This is what the people want, so this is what the people are going to get, and it's only going to be long-term inflationary. Even if the Fed tries to remove monetary policy like it's doing, that's ultimately not going to be deflationary. If providing money to Planet Palo Alto is deflationary, I don't know how removing money from Planet Palo Alto is deflationary as well. There is a wealth effect, clearly, like I referenced, but that is primarily the wealth of the rich, the holders of assets, right? And that doesn't as directly go to labor and the entities that are sourcing and causing demand. So, the odds are that we get my view is that the Fed is actually a little bit upside down here, that this response shouldn't be the response they have, but they have a mandate and they're being told to control inflation when they really can't. And their credibility, quote unquote, is at stake. And ultimately, I think, they're going to try and do this kind of Volcker moment where they blow up the economy to fix inflation. I use the analogy, it's kind of like dropping a bomb in a forest to clear the underbrush. It's like you're not really, you can get rid of the underbrush, but is that really what you want to do? So anyway, you asked again a simple question. I kind of went on a bit of a diatribe.
It's beautiful.
But that's
by the way, when you said Volcker moment, all the bears got goosebumps. I got goosebumps on the back of my neck.
The Volcker moment came at the end of a very different time and a very different economy where labor was the primary input. Labor is not the primary input anymore. I think we're at a very different moment in time, and I think that the Fed's making a mistake personally.
Well, Jeremy, we talked about this actually last week on the show, how you heard Powell out here talking about, how he recommended everyone reading Volcker's memoir, The Quest for Sound
Yep.
Money. And it was almost like he was trying to invoke that spirit
Yep.
in the tone of his conversation. But, Fed doesn't operate in a bubble. So while the Fed's dropping bombs on forests to clear out some of the weed, obviously killing all the trees and flora and fauna in its vicinity, we're not seeing the same type of thing coming out of Europe or Japan. And this is potentially creating other knock-on effects around the world, right? We have this very strong US dollar here. What's your take on how this plays out now over the next few months? Because, do you see something like another type of accord coming together, like Plaza Accord, in order to stop this runaway dollar? Or is it just totally unhinged?
We come full circle, right? At the beginning, you asked me how I started in the business, and I said I started in 1998. There's a little thing called the Asian financial crisis, the Russian ruble crisis, which eventually led to long-term capital management implosion. In 97, 98. That was on the back of the Fed raising rates and, broadly, a strong dollar. We've seen these throughout history when the dollar sees the kind of strength that it's seeing now, and it's likely to continue to see. Dollar denominated debt abroad becomes a problem. It's going to be exacerbated likely by the commodity push that we're seeing, particularly in foodstuff, where that tends to cause the biggest, strife internationally, right? So, buckle up in EM. It's only going to get worse. There's a lag to some of this stuff, particularly the food stuff, because fertilizer is a major. That's usually about a year lag to planting season, and so we're already having food issues in certain countries, but we're likely to see famine amongst billions, multiple billions of people on our planet in the next couple of years, and that politically that's not good, and for geopolitical stability that's not good. So a couple different inputs, but in tumultuous times you want to be on the biggest ship. Where America is actually in the strongest spot it's ever been because it's now energy independent. We are an island with the strongest military in the world, the biggest economy. Yes, the unwind of globalization is dangerous for everybody, but when everybody else needs safety, we're fortunate to be in a place where, where we will come. The inflation that we're experiencing is likely to be less bad because of the strength of the dollar, right? But we're going to be essentially exporting that inflation by the strength of the dollar.
Jim, the people in the chat are going crazy here. I promised you and your team that we would be respectful of your time, and you're so cool for coming on. I messaged you on Friday and you said, yeah, no problem, and you turned it around on Monday. I want to thank you so much. But you're not getting out here without me putting you on the hot seat.
All right.
We're gonna put you on the hot seat. I'm gonna throw a couple Greeks at you. I'm gonna throw a couple of underlying instruments, and all I want you to do is say long, short, in your time frame. Deal?
Okay.
Delta.
I'll do my best. Delta is the move in option prices per move in market.
You want to be long or short S&P deltas here?
Oh, long or short? That's what you're asking. I apologize that you're asking for a definition. I apologize. Delta here. You want to be selling the rips.
So that means Vega. You want to be long or short?
In the short term, you want to be long normalized Vega, short pure Vega.
The 10-year Treasury.
Oh, you want to be short the 10-year.
Short the 10-year. Do you have a rate in mind that you sort of are angling for? Like I hear a lot of the 3.25, 3.5s out there. Or is that way too low? You're like in the 4s or 5s. Like where are you at?
I don't want to scare people, but yeah, that's this is just the beginning.
Oh, sweet Jesus. Dollar.
Dollar strength.
I'm going to go as a basket.
Yeah,
so I won't do it.
Yeah. Dollar strength. This caught a lot of people by surprise when positioning is bad and macro trends are in place. Get out of the way.
Crypto. So give me Bitcoin.
Crypto. I don't want all the hate mail. Please don't send me the hate mail.
Oh no,
crypto,
these guys are okay. They're not crazy.
Yeah, no. Crypto is. It's a religion, so you can't bet against a religion. At the same time, especially in in a group that is coming to power over the next decade or plus. That said, it is unmoored. In a time of removing liquidity, it can go anywhere. So massive tails, own vol, and it will get ugly. But then I think eventually it will survive. And I do think I have long-term hope for not just blockchain being incredibly important in our society going forward, and not just important, like critical, like the underlying almost everything. But I also do think there is a important place for crypto, given the political support it will gain as this generation comes to power.
See, there's your olive branch. They're not coming. They're not going to come after you. You gave the olive branch at the end. Who could get mad at that? I'm gonna phrase this as energy. Go anywhere you want. If it's crude oil, natural gas, or if it's energy stocks in general, which have massively outperformed everything else in the marketplace, I'm just gonna call it energy, and just ask for your opinion.
Nuclear. It's that simple. I think I think if you look at energy, yes, energy broadly bullish, right? That's obvious. We are currently at about 3.5 to 3.7% of the S&P 500 market cap is energy. At the peak in 1980, it was an order of magnitude bigger than that, 35%. I think we're probably going to about 15. So I think there's a 5x from here in the next 8 to 10 years. I think I think that having been said, I think that energy demand colliding with the issues we're having with the environmental issues, ultimately only lead to one solution that actually makes any real sense, and that's nuclear.
Cem, you are the man. We can't thank you enough for coming on. If the people want to follow you on Twitter, if they're not already, if they're apparently living under a rock, they want to follow you on Twitter or find out more about Kai Volatility Advisors, let the people know where they can go.
Yeah, at Jim_croissant on Twitter, and at kaivolatility.com is our website. Interested investors can always go request actually a meeting with my team or myself on the website.
You ever wanted to be a YouTuber before? Tell these people to smash the like button and sub the channel. No, I'm just kidding. I'm just kidding. Thanks for coming on, Jim. We really appreciate it, man.
Thanks for having me, Victor. Take care. Nice being with you, Christopher.
Thanks, man.
Good speaking with you.
Bye, guys.
Oh, man. I got goosebumps from that. Talk about bear porn. I mean, we're talking about a Volcker moment. We're talking about, you know what I mean? He was dropping some truth bombs out there.
It was great.
Yeah.
Go ahead.
He's still with us too. He wants to linger around.
Oh, you can stay on as long as
no,
you want
just...
to. Oh, no.
Oh, now he gets the boot.
Ryan threw him out. Oh, no. Ryan, you got some splaining to do. He's
way to leave the show.
Ryan threw him out. We're trying to show him some hospitality. He just threw him out. But seriously, man, we're talking. I mean, we didn't go. We had limited time. We tried to hit as much ground as we could, but I think it's clear the point of view is very similar to the discussion we've been having on a regular basis, man. Which is, monetary policy is stuck. They're stuck short housing, for lack of a better term. They're stuck short wealth of the average American, and there's probably not any reprieve coming. And we've been saying that is 3850 a bottom? I don't know if it's as much as a bottom so much as it's an opportunity for shorts to cover here. And, it sounds like he has the same mid to long-term view that, we've been discussing here and you've been championing for a while, Chris.
Yeah, listen, I like when we have guests on that reinforce points that we've been telling the audience for a while. It never hurts. He's an oil man, clearly, like myself, Victor. He also is fond of nuclear energy as a stepping stone to getting us out of these problems that we have here right now globally. But there's something that he didn't say, but it was in between the lines. Like, monetary policy can't fix the mess we're in right now. It does not open more ports in Los Angeles or Miami. It's not going to fix China's supply chain issues. What's happening right now is largely outside of the Fed's control. So they're hoping that through higher interest rates, they engineer a slowdown in demand as a sort of secondary or tertiary effect through various channels. And that's not going to happen right away because it takes several months for that monetary policy transmission channel to play out. Look, Vic, this is like an anecdote to saying, is the Fed succeeding in their ability to tamp down the housing market? They're short housing. We purchased this home 2 months ago or so. We just had a new appraisal come in for a refinance. it was 10% higher than we paid for the home.
Mm-hmm.
That kind of house appreciation over the course of 2 months, but like that's not what the Fed's trying to achieve here, people. They're trying to get the exact opposite. If that appraisal came in below what we paid, they would actually be like, okay, cool, the housing market's cooling off. But it's moving in the exact opposite direction. And that's not the desired outcome right now. And it's not an outcome that they're going to be able to achieve just yet. I love this airplane analogy that he brought up, Vic, because it kind of dovetails with what we were talking about with Uber last week. Everyone had this, moment of reflection last weekend when Uber sends out this email how we're now going to focus on free cash flow. It's important that we start making money here because they see the venture capital funding is out of the market. They know that the public markets will not provide that liquidity that they need in order to keep their business going. So they have to fire people. They need to raise prices. They need to start generating more income. And that's what his airplane analogy is about, right? When you're at 30,000 feet and your engines go off, you have some time to figure out how you're going to land that plane. But if you're only taking off and the plane engines go off, you're coming down to the ground really, really quickly. So with that free cash flow buffer being that high in the air, it gives the business more time to survive and figure out a plan how to move forward before the whole thing crashes out of the sky. And we're still there. I mean, we're still in that moment where liquidity is being sucked out. The Fed's going to continue to raise rates. There may be some longer term opportunities if you have the patience and the stomach to look at some of these valuations, but these high flying tech stocks still, yeah, we had some nice movement up in ARK at the end of last week. Today we're back down. Bitcoin is back off significantly. We're probably not done with it yet. You have to be very selective in your choices, but learning the mechanics of the options market and knowing how to play these short-term swings, if it's around a VIX variation, if it's around OPEX, looking at skew, looking at term structure. These are ways that you can make very smart tactical short-term moves to perhaps help protect, insulate, and add alpha to your overall portfolio during these more tumultuous times in the market.
I thought what was interesting from the discussion was like having multiple dimensions of time and outcomes, expectations. In other words, knowing where we are in the OPEX cycle, and that you could start to see the effects of Vana and Charm into this OPEX, and within a couple of days post OPEX, and that you could start to see it, have an advantageous setup for a rally, but then also having a more mid to longer term view, which is perhaps the opposite of that. I think that's a key takeaway here. If you don't already have multiple dimensions to how you're thinking about markets, timeframes, and targets, clearly that's something that Gem is doing and positioning for short term as well as long term. And it doesn't have to be binary, right? It doesn't have to just be markets go up, markets go down. There's some dimensionality to it, which is exactly what options sort of allow us to do. But the other interesting part of that discussion, man, was sort of the monetary policy as the fuel for political instability. I think that's out there amongst these volatility circles. I don't know that it's discussed as often on sort of mainstream, I don't know, financial media, I suppose. And he had an interesting take.
We've been talking about it, how you have all this excess liquidity in the system, and now you have these supply chain issues. I mean, what happened the last time we faced a circumstance like this after the post global financial crisis stimulus steps? We had the Arab Spring, and it's been one of our concerns that we talked about here, not just because of fertilizer prices, which takes a little bit more than a year to play out, but wheat prices are up. That means instability for North Africa, for the Middle East, parts of Central Asia. It's going to be hugely problematic over the next year or two. And now in this environment, when you also have a strong dollar on top of it, it means that your US dollar denominated debt is more expensive to pay back because your local currency buys fewer dollars. It means that interest rates are higher. The debt's more expensive to service. And we're already seeing this play out. People aren't aware of what's going on in Sri Lanka right now. Go to your Google machine and check what's going on in Sri Lanka. They run out of money, basically. They don't have any access to fuel. Their food supplies are running low. And it's a knock-on effect of the environment that we're seeing play out, not just here in the United States, but around the world. And I know it's no comfort for a lot of viewers when they hear someone say, well, the US dollar is helping insulate us from worse inflation, because they look at the headline figure and they say 8.3%. Or the New York Times just actually put out a tool over the past week. What's your real inflation? They ask you questions. Have you bought a car? Did you buy any appliances? Did you buy a home? Blah, 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 blah. And it gives you what your actual inflation is based on the basket of goods that you consume. And so for me, when I did it, my actual inflation was up 10% year over year. That's more than the headline figure suggests that we're seeing from the BLS, where they say it's like 8.3% right now. But we would have much worse inflation but for the strong US dollar. And that means we're going to see much worse inflation coming out of places like the UK and out of Europe and of countries in Asia because their currencies are just so much weaker than the
Mm-hmm.
dollar over the last several months. Even Japan, something that Daniel Debrowski often points out here on the show, we have more inflation coming down the pipeline in Japan. They're going to get back to their 2% this year. And that's going to cause another big problem for the markets, Vic. If Japan has 2% plus inflation, does the BOJ just throw in its towel? And if we lose all that liquidity out of that corner of the world, how much more downside are there in markets out of Asia, out of the Nikkei, out of the Hang Seng? It's a whole nother can of worms that I don't think anyone's talking about yet. We've only flirted briefly with a passing eye to what that might transpire later this year.
To your point about watching the global economy here and its kickback effects, I wonder, I'm guessing you did because you're a market junkie, just as much as the rest of us, absolute degenerates. I'm guessing you saw the numbers that came out of China on Sunday. It was everything. It was on the industrial side. It was on retail sales side, on the consumption side. It was everything. None of it painted a good picture. So if you thought you were coming into this week and you're saying, oh, you got OPEX, hedges lifted, 3850 touched, you're in an optimal point to short cover, maybe some people want to take on some risk, which definitely looked like it was the case on Friday. All of a sudden, you get a little bit of, markets are drifting higher, Sunday futures. All of a sudden, they drop this Chinese data on the marketplaces and they puked them up, and they were relatively weak ever since, man. I wonder if you could speak to some of the data we saw come out of China on Sunday, and then what you think this means and how you have to think about China as a potential risk or opportunity, depending on how you see this, but like as a risk to the global growth just narrative going forward.
Sure. So data out of China was covering the month of April that we saw released yesterday, and there are really three different things that it showed us. One, retail sales for April down 11.1% year over year against an expectation of a 6.1% decline, so nearly double the slowdown that was expected. Industrial production for April, expected forecast gain of 0.4%, actually declined by 2.9% year over year. Fixed asset investment for April, we were expecting a gain of 7%, came in at 6.8. So those lockdowns, if it's in Shenzhen or if it's around Beijing, Shenzhen is the area just north of Hong Kong, which is a major industrial zone where we actually here in America rely on a lot of factories in that area for our supply chain. Everything is much slower because China continues to pursue this misguided zero COVID strategy. In fact, it's something that they find so controversial over there. The WHO, the World Health Organization,
Yeah.
like you like it, you dislike it. Conspiracy theories aside, we're not going to pedal on them for right now, Victor. But WHO comes out and says China needs to reconsider its zero COVID policy.
Mm-hmm.
And what does China do? They censor the WHO, even though the WHO has been perhaps their biggest ally globally over the past 2 years, providing cover for whatever origin of COVID there was when it came out of China. WHO has been there getting China's back, saying, no, it didn't come out of a lab. It was probably a wet market. We don't need to do any more research or investigation. It just is what it is. We have to move on. And now China's turning around and censoring the WHO because they don't want their own citizens to hear that zero COVID is a bad idea. So you have it showing up in the data now. We know that means there's going to be more supply chain issues moving forward. We know that it means that global growth will probably be weaker moving forward. Does that mean inflation stays stickier at a higher level here in the US? Perhaps, instead of getting back down to 4% by the end of the year, maybe we're still closer to 5.5, which means the Fed is going to keep their fingers pinching that spigot of liquidity closed for just a little bit longer, which means more air comes out of the bubble, more cream comes off the top. Difficult for crypto, higher US real rates. It poses more significant problems. So yes, the Chinese data is not great. It is concerning, and I think it just means that there's more pain, more volatility ahead. I don't like what Jim said about higher interest rates here in the U.S., but you know what? Sometimes
man.
You just can't fight the Fed.
I was fishing for it because you generally get people that are either optimistic or they're like, you guys aren't even close to wherever like the inflation expectations, currently are. And I was very curious which side of that fence he's on. So 3.25 to some people could seem like a pretty aggressive move in the 10-year right now, even though we're like 25 basis points, something like that away. But others, I've not a stranger to people who have that opinion that we are orders of magnitude away from where we could end up being with a flatter inverted curve somewhere much, much higher than where we are right now. It seemed like he was leaning towards that end. Yeah, I think people, you say like Shanghai shut down or everybody in Shanghai shut down. It's hard to understand the magnitude of that. It's basically like if I'm not mistaken, this is Shanghai like 30 million people, somewhere give or take like 2 million.
Yeah,
And
it's like
that's
25 million people.
yeah, that's like bigger than the top 10 cities in the US as of the last census, I think. It's like, and I know that's nominal is not a great comparison, but if you were struggling to get your mind around just how big of a deal that would be, what would our retail sales be if we shut down or we locked down the top 10 largest cities? And again, I know on a percentage basis it's not apples to apples, but I'm just giving people some way to think about that.
I mean,
Chris,
absolutely. Like we shut down New York, Los Angeles,
yeah,
Houston, Dallas, Chicago, Miami, Phoenix, just Boston, Philadelphia, just total lockdown, total curfew on when people can go out.
yeah.
If you
And
do
then
leave, you're gonna
and
get
then you're
taped up
in
and
the
thrown in the back of the
ballpark
truck.
of that number of people. It's a gigantic
It's still
number
higher
of
than
people.
that. Yeah,
Yeah.
exactly.
And then the weird thing too, because now I don't know how, I don't follow this closely enough. So what I'm about to say is just total conjecture. But like people are starting to get excited about the idea that they're going to be easing that. And maybe that's true. Maybe it rotates to some other city. I have no idea. But like, okay, just let 30 million people back out of their apartment. Good luck with your supply chain. Then you get the demand shock. You get all the bad things that we just kind of went through a couple of years ago, right? All the uncertainties. Anyways, let's get on to. I wonder if we could speak to a couple of these things before we get out of here. We still got half an hour, and I really want your opinion on some of the things that we just talked to Jem about. One, which is the U.S. equity market. We didn't get to do what we normally start off the session because we wanted to give as much time to Jem as possible. But let's give a lay of the land here. S&P 500. We're now closed in futures, but futures right at 4,000 and a quarter, down 19 and a half. Talking futures, my babies. The NASDAQ down about 1.1%. The Dow Jones all day was the outperformer. In strength, it outperformed. In weakness, it was outperforming. Ended up 3 basis points, a whole lot of nothing. And the Russell down 0.5%. Volatility contracted in terms of the VIX, VXN, and RVX. Contraction all across those things, all across the complex. I wonder what are your thoughts on market action today?
It seems like long value, short growth. I mean, at the high end of performers, you have oil, energy, OIH, XLE, IYE. Those are the leaders to the top side. On the downside, XLY, SMH, XRT. You're talking consumer discretionary, semiconductors, retail. You look at the regional banking, you look at home builders. All these were down by 1% or more. It still seems like we're very much in that risk-off type of move here. In the NASDAQ, even within the various sectors of the S&P 500. So it's not great price action. If you are a long high beta, it's certainly still seeing that we're getting some of that steam taken out of our sales, as it were, or wind taken out of our sales, rather. So for me, a lot of the things that I still have on, because I told you last week, I'm thinking about taking off some of these positions, like the short ARC trade, the short XLY. I haven't done so yet. So today was a pretty good day for me, net. But I'm starting to feel a little bit more comfortable again when I see price action like today, where we had an attempt at a rally on Thursday, Friday.
Mm-hmm.
We had some, wind in our sails coming into this week. The Chinese data smacks us lower. These positions are still working for me. So maybe I was wrong to even consider thinking about rebalancing away from energy, away from the long energy position, away from the short tech position. Perhaps there's a little bit more leg here. So I'm going to continue to let my winners do the heavy lifting for me. I've said this before on the program, but you got to think of yourself as like a baseball player in this environment. The goal here isn't to get a hit every time that you come up to the plate, but when you do get your hits, make sure they go far. Make sure you hit those home runs. Long oil, long energy has been good for me this year. Short tech has been good for me this year. Right now, it just seems that even when we bounce, we just can't hold on to those gains significantly. We can't build significant rallies. Ilya's right. Ilya's been saying sell rips. Jem was just on here telling us sell rips. So we got to keep selling risk in this environment until we have any sort of reason to do anything otherwise. And that's when the Fed tells us they're done with this aggressive stance. So I stick to my guns there. The Fed's nowhere close to being done. Williams today, when he came out, basically said stocks are too damn high. He's like that politician from Brooklyn, the rent's too damn high, stocks are too damn high. So I guess.
What was his name? I totally forgot his name.
I can't remember.
Rent is too damn
Yorker.
high. That's it was such a great slogan back in the day.
Right. And it just felt like that's the mantra from the Fed officials here. They're telling us that risk can come off. Look, I know this is a controversial stat.
By the way, did you listen? I don't mean to cut you off. I just, on your point real quick, did you listen to the that interview with Jerome Powell, that Market Watch interview? It was it was an audio interview. It was like a radio interview. They played it on Friday. And it got a lot of play over the weekend because, I don't want to say he backpedaled on a couple of things, but you're in the midst of an inflation fight, and the questions were all designed to sort of admit wrongdoing in some way, sort of admit maybe they weren't as aggressive, maybe they didn't start interest rates soon enough. With the benefit of hindsight, I think was his answer. With the benefit of hindsight, we probably could have started interest rate hikes earlier or removal of QE earlier, but I'm not entirely sure we'd be in a different place, was I think his answer. But just generally speaking, there was a lot of answers off of that interview that I don't know if it necessarily inspired confidence or credibility. On one hand, it's good to just be frank with people. On the other hand, it's also like you're in the middle of this thing. So like laying out your mistakes, I don't know if that really helps either. What do you think?
I think it's a little confusing for people in the short term, but I think about this from like the human psychology perspective. You have a friend, you have a coworker, you get into a disagreement with them, and they're clearly in the wrong, right? The longer that they go on denying that they've done anything wrong, the more upset you'll be, the more distrust you'll have with them over time.
That's
But
true.
if they come out right away and they say, I made this mistake, I recognize why this is a problem, here's how we're going to make it better, that anger and disappointment dissipates rather quickly, and the trust begins to rebuild there. So Powell coming out and saying, we probably should have moved sooner, it takes some of the bite out of his critics' point of view, because now they say, oh, see, he agrees with us. He knows he was wrong. Okay, well, at least they're doing the things now that they have to do to solve this problem. But Powell's also right in the fact that even if they raise rates sooner, what does it do for the supply chain issues? Maybe there's less.
He also said that. He said that as well. He alluded to the fact that, there's some things that they can't necessarily do anything about. So he did allude to the fact that, those supply chain issues are a bit out of their hands.
Yeah, so if the Fed raises rates in, say, December of last year or September of last year, right after Jackson Hole, is China not going to be in zero COVID? Does Omicron not come around? I mean, is that what we're going to really suggest right now? And obviously that's a bunch of, hooey. That's nonsense. China's not making its moves on locking down its population based on whether or not the Federal Reserve is raising rates. It's completely unrelated. Completely unrelated. Like that, it's one of those spurious correlations when, like, if the Redskins win their game the Sunday before the presidential election, then such and such candidate from such and such party is going to be elected. There's nothing to do with each other. So, yeah, the Fed could have raised rates sooner, perhaps tamping down demand a little bit more by tightening credit conditions, and therefore there might have been that incremental buyer at the margin who wouldn't have been able to purchase that thing with that kind of financing. Maybe that takes a little bit out of the bottleneck, but what does that do for other countries around the world? I mean, nothing. So Powell's admitting wrongdoing here. I get it. I think it's important. I think it's a step towards rebuilding trust with the financial and economic community here in the United States. But I think he's also correct in saying that it wouldn't have changed much of anything because, again, it doesn't impact China.
Yeah. I'm with you that this looks like a pretty defensive market with, energy, healthcare, staples, and utilities. When those are your outperformers on the day, I never think that's a great signal for risk.
Right.
Bonds were sort of a weird day. Rally generally early in the session. NASDAQ and tech stocks kind of found a little bit of a bid. Bonds sold off, middle of the day or something like that, and gave up some of those gains. But just generally, not a huge day for bond movement and activity. I'm curious though. You look at crude oil, man, and we're up at 111 again, 111.57. The chart looks scary, like a cat in heat. You ever seen a cat's tail that's in heat? It's all spiky or whatever. You know what I'm talking about?
We get our cats spayed and neutered, so no.
You're a monster. Okay. Let those animals live their natural lives. Stop
I
cutting
grew up
things off of them and sewing them up and doing all this. Let those
I grew up
animals.
on the Bob Barker mindset, spay and neuter your pets.
Anyways, somehow this is all this is all moving into crude oil somehow at 111. Your thoughts here, man? I'm not stepping in front of this train. Like I tried a couple of times to short some high beta energies and ended up scratching. I almost did it again last week. I think I'm gonna let this one go. This is not one I want to stand in front of here. And at some point, it's gonna turn around. Somebody's gonna make a lot of money. It's just not gonna be me. Your thoughts on crude oil here at 111?
Yeah, I'm seeing it up here right now at 114.83 right now for the continuous front month crude contract, CL1. And this is basically where we've been for the past 2 months. If you
Is
go
that the
back and
May?
look,
I think you're looking at the May then, which I think
yeah,
expires tomorrow or something. So
yes.
the June's at 111.
Okay, yeah. So when I'm taking a look at the charts here, I basically see if anyone out there is a technician, you take a Fibonacci extension tool. It's going to be from the low that we have in November 2020 to the high we had in October 21, and then the final lower retracement drawn to December 21 low. That's going to give you a 618 extension at 94.42 and a 100% extension at $114.20. In effect, but for 3 days in early March, we have been ping-ponging right between that $94.42 handle and that $114.20 handle. It's been back and forth, back and forth, back and forth. To me, it makes sense that we pinged to the upside because we recently came off of support. It does look like we have a little bit more of a leg here in order to push into some new highs. I think that the high that we had back on March 24th up at 116.64 is very much in reach. I think if we go beyond there, then we have our 123.6% extension up at $126.42. We put some highs in and around there back in early March. This seems like it's very technically sound, but momentum's improving. We're seeing our technical indicators point to higher prices in the very near term. It's good news for XLE or OIH or IYE, whatever you're trading here. XLE is coming in at new highs here today for the year. We didn't quite close there, Vic, but we did set a new intraday high for the year in XLE. So oil trade, energy trade is still working. We don't really see any types of the steps being taken in order to resolve this supply issue. OPEC Plus is not increasing production. The data that came out last week showed that U.S. oil production fell for the first time since January. That's moving in the wrong direction. We're moving into peak demand season here in the U.S. for gasoline right now as we approach Memorial Day and some of the summer holidays, if it's July 4th weekend or moving into Labor Day. So more pain can be ahead. And these oil companies are just making so much money right now. I mean, their free cash flow, Uber wishes they had that kind of free cash flow that your Schlumberger or your Exxon or your Chevron have. These companies are just making money hand over fist in this environment. And in an environment where you need free cash flow to survive, how are you not finding energy to be an appealing sector in which to look? Listen, Warren Buffett, the best investor of this generation, the last generation of perhaps all time in U.S. history. There can be some debate around that, but he is the name.
Some people put me up there. I'm just saying it's debatable. People are talking about it.
When the book on Victor Jones' life is written, you will be up there too, my friend.
I'll be up there, right along
you're
with
not 90 plus years old. You're not
right
90
along
plus
with Chamath.
Yeah, well, it's so bad. But Buffett himself is buying more Occidental, OXY.
Mm-hmm.
I mean, this
bought it. He technically bought it from what's his name, right? Anyway, sorry to interrupt. Go ahead.
Yeah. So the point is that you have one of the best long-term value investors of the past 50, 100 years in American history buying more energy stocks. It's because he values cash flow. He values companies that make a lot of money, and he's doubling down here. And OXY, another high here today on the back of this Buffett news. So yeah, I still have to like the energy space. I'm an oil man, Vic. I know that you're reluctantly an oil man as well, but it's working for us. Keep fueling to new highs. So you can't really dislike this type of price action. You don't sell a stock that's moving to new highs. I'm sorry. That's not how we play this game.
I appreciate you trying to give me credit, but this one's all you. This energy is moving up in spite of me, not with me. But that's just the way I rock. It was Carl Icahn. Carl Icahn closed his Occidental position almost at the exact same time. Um, Warren Buffett established it. That's the guy's name I was trying to think of.
No, I don't know if it was Icon or Ackman or, one of these other names out there, but regardless, it still holds, right? You have a long-term investor here. He's not trying to make a trade that's going to work well for the next few years because he thinks death is around the corner. He's sticking to his investment mindset. I know some people say like, oh, how can you trust Munger or Buffett because they're so old? Like, what do they care? They're not going to be around in a few years. Like, well, that's a really
Who
dark
says
point of view.
that?
I see it on Twitter all the time among crypto bros saying like they don't understand crypto because they're not going to be around for it.
Oh, okay.
They have a specific investment mandate, and there's a reason why they've been around for so long, because what they do and how they approach the market works. And so this is an environment that they have experienced before. They lived through the 60s and 70s and early 80s, and they made money during that environment. So the fact that they're still buying energy companies tells me that energy still has a long way to go.
I had this thought. I'm curious. I'm going to skip over to Bitcoin, but only because you talked about the crypto bros on your Twitter timeline. I saw what I think is a really good a good post. It was about crypto, and it was effectively about the previous drawdowns, that the bear markets that have occurred in Bitcoin, how difficult those were, and then the eventual price gains that you saw later on in the compound annual growth. So I thought it was a really solid post. The only thing that I would say to that is I think we have to remember when this asset started, right? When did it get its when was it birthed? And it was birthed into the zero interest rate policy. It was birthed into TARP, which then eventually led into QA infinity and the everything bubble where we sort of find ourselves now. So there's two things that I would say. I would say, one, we're headed into uncharted territory with respect to this particular asset class. If you think about it as an asset class, that's one. And then number two is there is no historical analog for it, precisely because of what I just mentioned. Therefore, it would make sense that the assets start to trade with high correlation to longer duration assets, because what else do you want to compare it to right now? You probably compare it to a longer duration asset, and I've got nothing else. I've got no other way to value this from an historical standard or from a historical analog. So perhaps it really shouldn't surprise us that going into this period that Bitcoin and crypto assets generally have never seen, that you're seeing higher correlations with sort of longer duration tech stocks, or with tech stocks more broadly, because what are you going to compare it to at this point?
I don't know. I think it was Scott Wapner over at CNBC today.
Oh, yeah.
You saw that tweet that was going around
Over the weekend, he went hard in the paint on Bitcoin and crypto.
Yeah, and look, there's a lot of people who are chiding him, saying like, you also helped prop up this environment by bringing guests onto the show to talk up crypto, and so your hands aren't clean. But I think the bigger picture is, we talked about the narrative flexibility that Bitcoin and crypto has, where they can say it's an inflation hedge, or it's a growth vehicle, or it's about in the future, or it's a payment system, or it's for value, or. But in every single one of those regards, it's failed recently over the past year. And I know people like to say, well, the US dollar's lost 71% of its value since 1980. Well, Bitcoin's lost 70% of its value basically over the past year. And so when you see inflation that's at like 2 or 3%, and that slowly chips away at a fiat currency, it's different than having a big drawdown like this. I mean, Bukele, the El Salvadorian president, he removed laser eyes from his Twitter profile.
I saw that.
I mean, if there was ever a moment that makes me think that perhaps we're getting closer to a sentiment washout, it would be things like that, because he staked his presidency on this. So look, Bitcoin is facing some troubles. It trades like a high beta tech stock. It has the highest correlation with the NASDAQ. That's where it is narratively right now. If you think the NASDAQ and tech is getting wrecked, then you have to implicitly think that something that's tech on steroids is going to get hit lower too. Like I've said, I'm bullish on the space longer term. I don't know if Bitcoin is the final iteration. I happen to think that Ethereum has greater utility, particularly for insurance and legal contracts. The smart contracts can be utilized in a very unique and appropriate manner moving forward. I'm also aware of some of the concerns around having these totally dispassionate arbiters in the space of the legal world, because it can't blame me. I'm not the one who did this to you. It was the algorithm, and that makes cruelty a lot easier between human beings. But there's a problem here, and it's not going away because the liquidity spigot is still being closed, and there is no environment that Bitcoin has faced over the past 15 years or 14 years of its lifespan that is like the one we're in now. Because as you rightly point out, we had TARP 1, we had TARP 2, we had QE 1, 2, Twist 3, all this liquidity coming into the system, and it's now what's the opposite of burr? Rib. Like that's what's happening right now to the system. So we got to just wrap our heads around that. Bitcoin's probably going to survive, but it may not find a low for a while. It could be back under 20,000. It could be back to 10,000. And when FUD's there, when FUD's in the tweets, when everyone's given up on it, that's when, people will start buying again.
Yeah. I mean, what I would say is, again, there's a multi-dimensionality of sort of time frame and target. And so I am short like the 35,000 calls in Bitcoin. I think I'm long the 30,000 puts. So I've been sort of doing this, taking off the hedge on really ugly days in crypto. And then for whatever reason, you get these days where it'll rally 2 or 3 grand. That skews. The puts get a little bit cheaper. People start FOMOing. Those calls get a little bit more expensive. And then you can, again, I just think you don't have to go face the unknown with assets that you like long term and just be completely, just say, all right, market, take me wherever you want to go. You can try to take control of the risk parameters and the risk that you're willing to take in any one of these asset classes, which allows your risk to match your point of view. In other words, what I'm saying is, if I'm long-term bullish, but I'm just going, I don't really care if this thing cuts in half. I don't think your position matches your point of view if you're saying short-term bearish, long-term bullish. Whereas you can structure your risk in these underlying instruments that more closely represents your point of view, both in the short, mid, and long terms. And I think there's opportunities to do that across all asset classes, not just Bitcoin, man. If Peter Schiff was here, he would dunk on you because gold just rallied $9 today, man.
Oh boy, gold rallied $9. Great. See you at $1,700 an ounce, Peter.
I'm just kidding. If somebody knows him, shout out to Peter Schiff or start atting him or something like that. I would love to have a conversation with him on the show. Wouldn't that be fun?
I would have a great time.
You don't interview Peter. Peter interviews himself.
Yeah, right. You see how he conducts himself. But Vic, we've been talking a lot about the macro environment here. I'm hoping that we could turn to some single stock names as we close out the show the last few minutes, because we have some interesting earnings releases this week. Walmart.
All retail, man. So retail is detail this week.
A lot of retail. And the one that I'm looking on is C Limited, SE, because this stock has been taken out to the woodshed here over the past few months. It was trading above $372 back in October, now down to $69.60 here after hours. If it's Home Depot, if it's Walmart, there is a ton of action in these names. Walmart, to me, is the one, if I'm thinking bullish, look, Walmart's a staple. Walmart is a place where people, if they are fearing that prices are too high, where are you going to go get a good value? You're going to go to Walmart. And Walmart sells, I think, more groceries now in America than any other grocery chain. That's been the case for a little while here, but Walmart is the staple among staples in terms of big box retailers. And if there is a place where we can look for some positivity, this might be the name. Walmart's up on the year. Walmart opened the year trading in at 144.30. We're at 148.15 right now after hours. So despite the fact that it's been a miserable year for the indices and for various pockets of this market, Walmart's been doing pretty well.
What did XLY do today? Down 2%. Tesla was weak today, right?
Tesla was weak today. Everyone is wondering, is this Twitter deal still in play, or was Elon merely saying that Twitter was an excuse for him to sell some of his Tesla stock a few months ago? Right.
I don't think it is.
Obviously, a big bad.
I read something about how Elon I think the way he thinks about life is the same way that Jem thinks about, he constructs distribution curves. It's just probability. There's a wide range of potential outcomes. And I read something a long time ago around the way Elon thinks, and it's just a bunch of scenarios. And he did. I think he was at the All In. There's the All In Summit. So the All In podcast is doing like this live in person event. So I think Elon showed up and did a live in person interview, and I think he talked about talking the Twitter deal down. Like, there's a chance that the deal gets done, but at a lower price. And it's just like, can you say that? Isn't that a material disclosure that he's making just off the cuff in an interview? I think it's in Miami or something like that. Aren't there channels you have to go through to say something like that? Or can you're in an agreement with this other company? Of course, you could pay $1 billion if you want out of it. It seems like you're finding every legal way to get out of it, or to use all of your leverage, which he has all the leverage in this situation, to talk this deal down to a lower price if it even gets done, which if it doesn't, I don't really think it really matters to him. Sorry for going on such a big aside, but I was actually just wanted to know why XLY was so weak, and I think it's 40% Amazon and Tesla, so usually that answers the question. Back to your point, so Home Depot earnings tomorrow before the open. If you didn't get anything on, it's too late, unfortunately. It's got a 6% implied move. Walmart, most staples don't have really sexy implied moves, only 4% implied on the earnings event. But to your point, you also have retail sales tomorrow. And I think generally speaking, if I were to say, is the market painting the consumer with a positive or negative brush? I feel like recently they've been pricing the consumer the right way, which is to the downside. In other words, they've been bearish on consumption, which I think is the right way to go. I don't think we're fully there or where we need to be. But who knows? If Home Depot tells a decent story, Walmart tells a decent story, you get retail sales that don't come in horrific. I think the consensus month over month is like 0.9%. Who knows? To your point, maybe you do get a bid in some of these staples like Walmart.
Look, there's a good and a bad to what's happening right now with consumers. The good news is that people are still spending money, and that was one of the positive silver linings of that first quarter GDP report. We saw that consumption was still quite strong. The bad news is that it's because people are taking on a lot of debt.
Yeah, it's all credit card debt. Why is nobody saying this? It's like everyone's like, the consumer's strong. No, the consumer's putting all of this on unsecured revolving credit lines. And that is okay in the short term, but you're kicking just like we're taking on all this debt. We just kicked the can down the road 40 or 50 years. So you think everyone's just okay with the fact that consumers doing the same damn thing? Their cycle's not going to be 40 or 50 years, everybody. Like, at some point, you got to deal with the fact that you just put groceries on a credit card because they're ridiculously expensive, or you just filled up the tank on a credit card because it's ridiculously expensive. It's not because of the airline points. You're doing it, people are doing this because this stuff's too expensive.
Yeah, according to the New York Fed data that was released last week, credit card balances are still $71 billion higher than in Q1 21. So yes, like, consumption's up, but that's also a function because prices are up, right? When we talk about how these things are computed, you can basically boil GDP down to P times Q, prices times quantity of goods produced. And so if prices double, that doesn't mean GDP is doubled. It just means that people have paid twice as much for the stuff. So that's kind of where I'm at. Like, yes, it's good news for the headline GDP figure, but the manner in which we're getting there is pretty unhealthy long term. And as interest rates rise, what happens? That means your credit card bills will increase if you can't pay off all your debt. So, like, a friendly personal financial tip out there, don't carry any credit card debt right now, because it's going to get more expensive to service the longer you keep your balance intact. Pay it down if you can as soon as possible.
You watching the squawking that Jeff Bezos is doing at the administration?
Yeah, it's so funny how Jeff Bezos is saying, using his platform to say that people like me aren't responsible for the high inflation. It's you, and don't tax me more. I mean, listen, he has a valid point, right, to a certain degree.
Yeah. I think what he's trying to say is there's a bunch of diversions happening and misdirections. I think that to a large extent is true. And then Larry Summers clapped back at Jeff Bezos saying higher tax rates will also, they will, if done correctly, they can help ease this situation. So in a way, you're wrong as well. So it's like, and I know how much you love Larry Summers, but even Larry Summers, who is defending the administration, is also saying that a lot of what they're talking about, like they're blaming inflation on price gouging and all this other stuff. I think he called it the equivalent. He said that is to economic science as Trump's bleaching to solve for COVID-19 was to medical science. That's what he said on Friday in an interview.
That's a hell of a take.
That's a you only write that line if you want that to get picked up in
Yeah, exactly.
in PR.
The one thing about this inflation is it made Larry Summers stay relevant. I mean, that's definitely the worst part of the inflation.
You got to give it to him, man. I know you're bearish, but he's been dead on. He has been dead on his calls on inflation throughout this whole situation. He's been 100% dead right.
He's been right for the wrong reasons, though. So I can't give him any credit. So sorry. Sorry, Larry.
I'd rather be lucky than good, honestly. If you told me, if you look at my portfolio P&L and you said, yeah, but you had the wrong thesis, I'd be like, all right, that's fine with me. Let's do it this way, man. I'm still walking on clouds from the interview we got to do with Jem earlier. A special thank you to him. Please, if you're watching this live or if you're watching this on demand, do us a favor, show value from our world to theirs. Go on Twitter, follow him. At Adam, mention him if you liked the content. Just make sure, all of us at Tasty Trade, we're loud. Let's shake the cages a little bit. And if you don't know how to follow our co-host or where to find all of the interviews and, articles he's putting out, I swear this guy's one of the hardest working people in this business. Chris, tell him where to go.
You can always follow myself, Thomas Westwater, Ilya Spivak, Dana Dabrowski over at dailyfx.com. You can follow me on Twitter as listed below at CVecchioFX. Is it listed below? It is listed below at CVecchioFX. I'll be back here tomorrow and Thursday this week.
We got a special one tomorrow. We're bringing in Dan Ives, who is, if you don't know him, he's from Wedbush. He's been one of the most bullish analysts on the street on a couple of the FANG stocks. I think Microsoft, I think Amazon's in there, Tesla's in there. So we're going to have a good conversation with him. He's a good dude. He'll take some friendly fire. He'll put our toes to the fire as well. So we got a really, really good week lined up here. If you got questions that you want to throw at Dan Ives, tweet to me at Victor Jones. The Owen Jones is 0 because I like to be difficult, or tweet at my good friend Chris Vecchio here. If you've got fundamental questions, valuation questions, price target questions on stuff that he follows, feel free to shoot it at us, and that could only inform the interview for tomorrow. For everybody here, I want to say thanks, Chris, for filling in tomorrow and also making this show fun to do on a day-to-day basis. Until next time, everybody, I've been Victor Jones.
I've been Chris Vecchio.
This was another episode of Jones and Friends. Until tomorrow, we'll see you, folks. Peace.